Let's bring in Chris Weston. He's with us from IG in Melbourne this morning. So, Chris, we're just hearing that reporter saying, watch out for October. But how do you think that jobs report sets us up for the new week?
Well, I mean, it gives us some encouragement, but I will kind of make a little caveat that strategists and economists have been saying proceed with caution for about 6 months, and it's for that very reason that we climb the wall of worry every time, and that's why the S&P has made something like 33 new highs for the year. If it was this unadulterated euphoria, we'd probably be 5–10% lower than where we are at the moment. But every time there's a pullback based on some sort of macro concern, traders just come in and buy the dips every time. But I think this week's really, if we're looking at the US, it's got to be about the minutes this week, and I think probably or should we say less stale. We've got to look at the 14 different Fed members who are going to be coming out with different rhetoric throughout the week as well, and one of them is Bullard, and I think whilst he is not a voter, I think he's come out with some very interesting comments of late which suggest that the rate that we've been seeing in terms of the fall in the participation rate is a structural issue. He's also been talking very predominantly about what's happening with the US dollar and how that could potentially impact the economy, but also is calling for rates to be put up in the first quarter as well. So I'm going to be listening to what he has to say, as well as Stanley Fischer. I think he's been coming out, and Bill Dudley as well. So I think there's going to be some interesting Fed rhetoric to look out for this week.
Okay, and we've also got the ECB President Draghi speaking. The topic is the latest developments in Europe and central banking, and that's in Washington on Thursday. But I guess that's only just going to put into stark contrast, the two fortunes and why you've got the US dollar moving as it is. Huge move on the weekend.
Oh yeah, for sure. I mean, the euro is just an absolutely horrible currency to own at the moment. There is really no reason to be doing it. The ECB themselves are pushing money out of Europe. They're doing that by imposing negative rates in the front end. If you look at I think there's about 6 countries now in Europe which have negative two-year yields effectively. So I think we've actually heard big reports from European banks taking money off the ECB's balance sheet and put it with the UK central bank, as well as the US central bank as well, because they're still paying money on reserves there. So I think that's a very interesting phenomenon, just in terms of what we're seeing on the growth prospect as well. I mean, last week we saw the Bank of Italy, or the Central Bank of Italy, coming out downgrading their growth forecasts. We know there's concerns about France, the fact that they've pushed out their plans to reduce their deficit next year, and as I said earlier, they've got to roll over probably the most amount of debt that they've ever had to do next year. There's political concerns coming through with the rise of Marine Le Pen's party, the Syriza party in Greece as well. So I think there's absolutely no reason why you'd want to be looking to own the euro, with the exception of some short covering, which will be coming against the pound and against the dollar there.
Bring it back to the local market for us as well. How's the Aussie positioned this week after that the 1.5% fall that we saw on Friday?
Yeah, it's difficult. I think the Australian dollar, I mean, if you do any kind of modelling on the Australian dollar at the moment, if you look at it on a real effective exchange rate, which is effectively the basket of the Aussie against the basket, and you adjust it for inflation, if you look at that real effective exchange rate on the Australian dollar, and you put it into context of where terms of trade are at the moment, the Australian dollar has significantly further to fall. I mean, everyone talks about the fact that it has declined, not just against the US dollar, but on a trade-weighted basis. If you look at it against its traditional drivers and what goes into the key valuation there, I mean, it has significantly further to fall, especially if you look at other metrics like purchasing power parity and the OECD metric there as well. So I see longer term downside in the Aussie. I don't really see any other way on a trade weighted basis, but certainly against the US dollar. But this week I think the RBA is very much in tune here. The RBA is going to be a really important metric to look at. The statement's going to be very interesting, not just on the macro prudential tools, and if we get any kind of further rhetoric about that, but also what's happened with the Australian dollar. We've seen a fairly big fall since the last meeting. Is it enough to overcompensate the fact that we've seen the terms of trade fall as well? And last week's commodity index really coming off and showing that very clearly. So I think that's very important. Of course, the employment data is going to be very key towards the back end of the week. If I was going to be running any kind of positions on the Australian dollar this week, it would be against the Kiwi dollar. I just wouldn't be buying the Australian dollar against the US dollar, but potentially you can look at it against the Kiwi dollar if you are looking for a trade at the moment. That looks technically okay at the moment.
I just find this one of the most interesting things to start the week, the range of expectations that you've pointed out to us for that jobs report. Because remember, we had that 121,000 jobs added last month, but I don't know, have we ever had a range of 100,000 in our expectations for local jobs, Chris?
No, not at all. I mean, it seems that whenever there's a consensus, it's either 5,000 or 15,000. But
yeah,
you know, I think the word dartboard comes to mind. To be honest, Brooke.
Right.
I mean, it's or lottery, I suppose. I mean, it really is a lottery anyway. To be honest, we know this is one that traditionally has the actual print comes well out of expectations. So I think probably the unemployment rate's going to be very interesting. People look at the amount of jobs to the actual the workforce to the actual the total population is a good ratio to look at as well. But yeah, I think it's quite interesting now that we have an unemployment rate significantly higher than that of the US, and I think that tells a fairly clear picture. I mean, obviously our population's vastly different. But yeah, I mean, I mean, 100,000 losses. I can't remember which house is looking for that.
It's Bank of America, Merrill Lynch and Macquarie. I just double-checked it. And I think AMP says no change, and CommSec says we drop about 10,000 jobs. It's just incredible. Yeah.
Well, it is, and I think you've got to look at the actual quality of those jobs. Is it full-time? Is it part-time? Yep. There's always bits to do it, and I know people do trade around this announcement. It always, in fact, in terms of the actual economic data that we get here in Australia, it probably has a fairly big significance naturally, but I don't think there's an economic release that creates such a sizable move in the Australian dollar outside of that of obviously the RBA announcement and the statement that goes with that. So in terms of actual day moves that you get in the local unit, you tend to get the biggest reaction in this employment result. So it could be quite interesting, but certainly the markets and certainly the consensus is we get a bit of payback from last month's blockbuster number that we saw last month.
And one other thing we should mention with you from the weekend, Chris, is there was a statement that was put out by the PBOC. PBOC basically they talked about the complication in the economy which can't be underestimated. This was posted to the website about its third quarter policy meeting. They're saying the economy's in a reasonable range, financial operations steady, prices stable. They did kind of talk quite a bit about the yuan though, the push forward for reform, the fact that it's quite balanced at the moment. Is there anything in that? I mean, obviously it hasn't moved the Aussie dollar this morning too much. Is there anything in that though worth kind of taking away?
I don't think there's anything new, to be honest, Brooke. I saw the headlines and the statement myself, but you know, we know that they're going to continue pushing on with the yuan and interest rate liberalisation. In fact, I think what's quite interesting is there had been some rumours over the last couple of weeks that the government may actually put pressure on the head of the PBOC, Mr. Zhao, to step down because he was too reformist. And if you do become too reformist, then naturally that has negative implications on growth as well. Everyone's looking now forward to the China-Hong Kong Connect, and that's going to increase the amount of inflows into China. And for me, part of that reason why we are seeing the Shanghai Composite pushing the highest levels in quite some years is because people are front running this idea that a lot of international capital will be making its way into the A-shares market in China. So I think that's probably quite interesting in terms of the liberalisation of China. But they have come out. One of the key points there is that they are continuing to use prudent stance within monetary policy. That's not new. That's something that they've been maintaining for quite some time. But they're going to try and offset any prudence with ample liquidity. And you know, if you look at the 7-day repo, for example, which is a sign of liquidity in the Chinese market, it's still very low, and I think that really highlights there. But we're going to see if you are looking at the Chinese market at the moment, the most important thing for us is what happens with very targeted stimulus. And I think that they've got a range of different products that they use within China, but it's pretty clear that they are using these liquidity measures, and they're using that and they're putting it directly into the banks to try and increase that liquidity. But we're not going to see right now, based on this statement that they are going to have prudent monetary policy, it tells us right now that doesn't seem they're ready to actually come out and cut reserve ratio requirements or actually cut their benchmark interest rate. But what they are doing is liquidity and actually leaning on the regional banks and the big banks to try and promote lending within the housing market and keep that housing market supported.
Fantastic. Chris, thank you very much. Appreciate your time today.
Thanks, Brooke.
Thank you, Chris Weston from